Howdy. All right, good evening, guys. Ken at Tortoise Capital. This is the Foundation's Q&A check-in for February 1st, 2024. We got two questions from Hamad tonight. The first one is on the range stat, and the second one is on re-entry strategies. So we'll just do first things first. The first one, the range stat. Oh, that's, hang on. How do I treat the range stat? And he says, I'm noticing sometimes the range stat is respected, other times, especially when we have economic releases like the FOMC or an earnings day, the range stat is not respected. The impact of those events on the volatility of the symbol is understandable. How at times, even though we don't have an economic or financial event, the range stat is not respected. Yeah. Okay. So this, I want to clarify how we should be thinking about the range stat. Okay. So the first thing is just to review the definition. The range stat is the maximum reasonable intraday move, and it's computed by looking at the last 30 days, the ranges of those 30 days, which is high minus low divided by price equals a percentage. And you have to do a percentage so that you can normalize the size of the move over the life cycle of the instrument. Um, because if it's $50 stock, and the range is $2, that's a 4% move. It moved 4% of its price intraday. If it was $100 and moved 2, that would be 2%. And so the next day, if it was at 110, and you thought, well, the range stat is clearly 2, or whatever if that was the range stat for the day, then I have my maximum reasonable intraday move is 2. But no, you're actually, you can't compare those because one of them is twice as volatile as the other. So that's why we have to use this formula: high minus low divided by price gives you a range percentage. So we take the last 30 days of range, and then we sort it by max to min. So we just have 30 data points. And then we find the average, and then we compute the standard deviation. And then we take plus or minus 1. So that gives us a z-score. So if we have the maximum range was here and the minimum range was there, and then plus or minus 1 is here, this gives us a range of normal. And this would be abnormally large, and this would be abnormally small compared to a measuring device. I want you to think of the range stat as an adaptive measuring device that allows us to classify the size of the move into reasonable and unreasonable, or to use Alan Greenspan's words, irrational exuberance. And what that lets us do is make an estimate of the size of the potential move. So when we're trying to calculate risk and reward, um, and we have some pattern, we have a harsh winter and it reverses, and we have some kind of risk box, and then we're going to put an entry because of rules, and we're going to put a stop here. That's really clear. We can actually measure that directly from the chart because we can see what specific price, instead of going up, if it fails, we have a very precise price based on a specific pattern that tells us when we want to be short. And so we can define the risk element very clearly, but we can say, well, what's the reward? I mean, I can imagine this happening, happens all the time. But my real question is, since I want to have a 2-to-1 reward to risk ratio, I have to now say, is it reasonable that this thing could move two of those boxes in order to get my 2-to-1? Is that reasonable, or am I just using my intuition because I really want to trade it? I say, yeah, I could get there. So I want to have some kind of calibration on that estimate. In a larger sense, for day trading, I want to have some reasonable expectation. If that's my open, here was yesterday's close, and so this turns out to be the gap. I want to have a sense right from the open, what is the maximum reasonable intraday move? And then if I can do that, then I can say that is my playing field. That as a professional, I'm not allowed to be surprised if price were to move all the way up here, then maybe all the way, or all the way down to here. I'm actually not allowed to be surprised. I'm allowed to be surprised. Okay, so I can't be surprised if it went all the way to here. Like if that turned out to be the low of the day, and then it came up here to this maximum reason, or it went down here. What would be surprising would be if it went all the way to the maximum gain and then came all the way back that way. That would be surprising because that would be twice the size of that reasonable gain. So we're going to use the statistics now. Uh, and we know that the normal accounts for 2/3 of the ranges of the last 30 days. So 2/3 of 30 is 20. So when you compute the standard deviation plus or minus, about 20, the middle 20 days approximately, it can vary, but you get about 20 of the 30, yeah, 20 of the 30 days inside that range. And then only about 1/6 of those days are less than normal, and only 1/6 are greater than normal. So if I were to say the smallest range that it could have would be 0, and I start adding up these probabilities, there is a 1 in 6 chance that it is less than the average range minus a standard deviation. So that's about 16%. And then there's about a 67% chance for that middle 2/3, which means that the upper limit of normal, if I go average plus 1 standard deviation, that accounts for about with rounding error, about 85%, or 5 out of 6 times, it's not going to be a larger range than that. Only one time out of 6, in other words, one day out of 10, and it's not even quite, or one day out of 5, I mean, it, we could expect to see one day a week where it was going to be more than a range stat, which means most of the time it's going to be less than a range stat. So when it opens, it is simultaneously the high and the low of the day. And if I'm saying, if it's an up day, if this is one of those 2 days out of 5 when the open is very near the high or the low of the day, if this is an up day and it just opens from here and went straight up, I can use that statistic and say, if it's a normal day, 85% of the time, it's reasonable to think it will not go higher than a range stat. So that puts an upper limit. And then if if that turned out to be the high of the day and it starts selling off, 85% of the time in the past, it didn't go farther than this. Those two limits now become the size of the playing field that I can establish right from the open. What that lets me do is start estimating the amount of the move that is left. So suppose this thing, and I'll put this one in orange. Suppose this thing moved up a certain distance and then came down a distance, didn't make a new low for grins, and then starts to resume. So I have something like a kata 2 pattern. And now I want to, the RL10 goes across the dragon, and now I want to buy it there. And according to my rules, the size of my wrist box is like this. So here I am in this trade frame position, and I've got the entry that I want. I say, is there reason to believe that there's 2 units of reward still available? Well, since I since I know where the low of the day was, it was right there, and my entry is right here, I can say, are there 2 of those boxes available? And I can quickly plunk it on there and say, yeah, there's a 2-to-1 that's available. This is a reasonable trade because I'm going to get 2R before it goes to the maximum reasonable intraday move, which is the range stat. Only 15% of the time in the past 30 days did it ever move farther than that line during the daily move. Check or hold. Now, since the range stat is updated every day, the size of this move, or the size of this yardstick, of this ruler, of this measuring device, is adaptive. That as you drop off a day and add a new day and recalculate, that number can vary a little bit. Not a lot, usually, but just a little bit. So all I'm using that for is trying to say, this is rational exuberance. These guys were excited about the opportunity to take that move, and it's going up, so they like it. And rather than just indiscriminately chasing it, this adaptive yardstick, this adaptive ruler, now gives us the ability to answer the question on a professional, adaptive, systematic, disciplined way. Is it reasonable to get 2 units of reward for the unit of risk? Now, if you're using something other than like the PSAR flip, well, whatever you're using to calculate the reasonable risk that you can manage, and that's why we like the MMRB, because we are in search of reducing the size of the initial risk box so that it's easier to get to a 2R win and yet still never take more than a 1R loss. That's why the search for the MMRB is so important. So no matter what method you're using to decide how much execution risk you're going to take to answer this part of the ratio, to compute the reward, you have to have a reasonable way to estimate an upper limit. Now, we can do things like looking at the chart and we can look at the previous price action and we can say, yeah, this thing has made those peaks in the RL10 at various times. And now it's down here and now we're getting our entry and we're going to go. We can say, well, when we look back, we're not allowed to be surprised also if it stalls at the previous peak of the RL10. So those give us very specific price levels that whenever price gets there, and not necessarily today, but any day, if price breaks out and starts going north, we're not allowed to be surprised if it fails at the same place that it failed last time. And then we're allowed to say, but if it does get through there and there's no resistance levels in here, it's not unreasonable to expect it will keep going up before it gets to the next failure point. So we can use the previous statistical highs as ways to find very specific price levels that allow us to anticipate reversals. That's why you always see me drawing these lines. My real question, though, is on an intraday basis, is it reasonable or is it unreasonable that if this thing works, it could get that high today in the amount of time remaining? And that's why we're using the size of the daily ranges in order to calibrate our expectations or our understanding of the size of a reasonable versus an unreasonable move. Now remember the range stat is not a prediction that it will move that far or that it can't move farther. All it is not a prediction, it is a description. It's simply the measuring stick that we're going to use to say whether or not we think we can set up a reasonable 2-to-1 or what kind of a day is it today or what kind of a day could it be, because now we can actually go to look at the gap stat, and if we say this was the close yesterday right here and then it opens here, in the moment of the open, this is simultaneously the high and the low of the new day, and that's why I can establish a plus R stat and a minus R stat right from the open and say those two prices are the maximum reasonable intraday move. Now, I can now find out the percentage of the gap and I can say, was this large or normal? So that's going to be taking a look at the size of the gaps of the last 200 days. And then we can establish the average gap plus 1 SD equals the gap stat. And what we know is that if it's a large gap, then the probability of seeing a range stat move or beyond today is greater. So if I have a large gap, as defined by average gap of the last 200 days plus the standard deviation, and that's the absolute value because we know that the direction of the gap does not predict the direction of the follow through. I just know that if I have a large gap in either direction, I'm more likely to get a range stat move or larger today. So that allows me now to be prepared on days where there's a large gap in my favored symbols to be ready to start getting 2 or 3 positions in, and then not to be surprised if it goes beyond a range stat. Now, one of the things that we've noticed is that if you have this as the open and you had some kind of the plus range stat move up there, if this is the kind of day that breaks through the range stat, we've gone from the world of rational exuberance to the world of irrational exuberance. And what that means is you can't use the rules that you use down here don't apply up in here. We have to have standard work or new rules for abnormal times. So I replace the normal rules with the rules for how to manage trades once they get beyond the boundary of irrational exuberance. So that's what the range stat does. And the gap stat allows me to be prepared for days when the move is going to be larger. Now here's another little phenomenon that happens. So if I open here and now again I do a plus and a minus range stat, and let's say this thing moves up a certain distance and then starts to peak, and let's just say it was half of a range stat, right? Well, now price is starting to fail, and now I may be thinking of uh, like a Kata 2 short or a collapsing dragon or something. I don't know, but maybe, yeah, maybe it looked like this, and now I'm thinking about a collapsing dragon move right here. And now my question is, how far can this thing move to the maximum reasonable intraday move? Well, when the market first opened and price was here, the maximum it could move from the high of the day minus a range stat was this price. But now I've got a new high of the day. So now what I have to do is take the range stat and anchor it to that point and then drop it down and say, this is now my new price limit. So now if I get short here, the maximum reasonable move is to there. And if my risk box is here, then that's okay because I can see 2 to 1. But now you can see instead of waiting for the collapsing dragon, if I decided to get short here with a supported fall crossing or a pocket entry or whatever technique I'm using to enter, this is still the high of the day. This is still the maximum reasonable intraday move now. Now my opportunity is to gain, 1 or 2 extra units of reward simply because I'm entering higher on the stack. So whenever if that's the plus and minus range stat, if this goes up a little bit, then my new lower limit is like right there. You're trailing it with a range stat stop essentially. And if this goes up a little bit more, then this goes up a little bit more. If this comes down to here, and now this is still the new low of the day, this is still the plus range stat. But if this now starts dropping down to here, now suddenly the range stat upper limit looks like this. And what you end up getting is at the moment of the opening, you have a potential move that starts here, but then as price starts unfolding, the size of the remaining reasonable move starts to narrow until whatever happens out here. And then at the moment of the close, you end up getting something like a high of the day, the low of the day for the range, and maybe that was the real body. So what starts at the start of the day, you have a single point of price and you have a potential candle in either direction with a range stat for the maximum reasonable move. And then by the end of the day, you've gone from a potential day to the actual day. Now, the final thing I want to say about range stat is that 5 times out of 6, it won't go more than that. The days that it's more likely to go on that is when you have a big gap. But now here's the other thing. When you do have a move that goes beyond the range stat, the size of that next move, it's you're not allowed to be surprised by the size of that move at all. Because one of the things that you study, if you are studying your symbols and you want to specialize in a symbol, these are the sizes of the moves that you want to know about the things that you routinely trade. Why not lower the range stat on the RL10 wiggle versus trailing?
My
I
question
don't
was
I
for
don't understand.
check. When so you have the opening and then the
Yeah,
RL10 goes up a little bit and then it starts going down.
yeah.
Why not just ratchet the range stat to the utmost highest point and just shift it down to that RL10 peak?
Yeah, because the upside move, it starts from the low of the day plus the standard yardstick of the range stat. If it moves up and then starts to wiggle down, the what you what you want to measure it from is the highest absolute price and not the RL10. There's an argument for why it could be the RL10, but the actual statistic is computed by the wicks. And because the wicks can be in the noise, we still want to be able to incorporate the possibility of one large tail in either direction. Um,
Got it. Can you have you ever considered the on that wick for the highest point, just ratcheting, then that being the start of the range stat, then going down? So you
yeah,
like
that's
have
what
a
you do. That's what you do.
oh, okay, okay,
So
check.
so if I had a price that went like this and there was some great big old wick and then it started ratcheting like this, right? When the RL10 is computed, it would probably look like, let me get a blue line on there. It would probably look like it's tracking pretty close. And then this big move up here, it leaves the R10 lags a little bit and then it catches up and then somewhere in here it rolls over and comes back down. So let's suppose that this was the opening right here. And let's suppose that I had, that was the open. And let's suppose I was using some kind of MMRB box to get a hybrid frog entry because maybe this was a large gap. And so I bracket the open and I'm ready to go long or short on an MMRB move, check or hold.
Check.
So now I set up that frame and now I get long here. And now here's my maximum favorable excursion. And it could be that when the R10 rolls over, I decide to get out, like maybe a 1, 2, 3 exit. Maybe that's where I get out because hey, it's already moved more than an MMRB off the top. So I don't want to give back any more. My open gain is this. At some point, this was my maximum favorable excursion, but it's already started to fail. There's one risk box, and now it's come down here, and that's a 1, 2, 3. So I just take that. All right. So I gave back that much, but I was able to keep this much. Well, now maybe the dragon, which lags a little bit, maybe the dragon is like this, and it's starting to roll over. And maybe I decide, you know what? I'm gonna take I'm gonna take the RLXD because I think this was some kind of anomaly. It was a parabolic move and there was hardly any volume. So I'm going to get short right here. And now I'm trying to figure out how far down can I go. What I have to do is go to the top price of the day and then hang the range stat down from there because the range stat is computed from actual price data, not from the RL10. So we want to know where the statistically significant turning point is, and that's where the RL10 peaks and then drops. That's a really important price level like if this recovered and started going that, the place that is statistically significant for new buying pressure is the emerging dragon, which is the peak of the RL10. That makes this the pocket between this peak of the R10 and this peak of the R10. So um, those become important price levels to consider. Like I could get in here if price goes across the dragon. I can enter here before it hits this, but the high of the day wasn't until here. So if I take either one of those entries, I am front running all the guys who said, well, I'm going to wait for it to break out above the actual high of the day. And so they might be putting a bunch of breakout purchase orders up in here. And so when price moves up through that, if price were to move from here and now it breaks above the new high of the day, now all of a sudden all of those orders hit and you get an explosive move up. Well, if I wait for that to happen and I put a market order in, where am I going to get filled? I don't know. This it is moving with great volatility. So one of the advantages of buying earlier in the move is you're buying at a statistically significant turning point, but you're getting in before all of the guys who are simply using the highest high of the candle because we're using the peak of the dragon or the peak of the RL10. So, short short answer is when you're computing the size of the move to the downside after a reversal, you have to go to the high of the day and drop the range stat. But when you're looking at reentry decisions, we're using the statistical significant turning points in the same way that if we're going to get short, here was the harsh winter and there was the R10 reversal and there was our SSC up, it failed. The the actual price bars that were part of this might look like that. And so the low of the day is right there, but the significant low is where the R10 changes. So as this starts failing, if I can get my entry at the collapsing dragon, I now can front run with that much of a buffer with the understanding that I can expect that if this price goes down through here, there's going to be a bunch of guys that have stop orders here just below the low of the day who were buying it long here. All those guys who were buying it there are putting their stop orders just below the low of the day. But I can get short here because that's the statistically significant price level. And this is usually not as volatile in here. So I can sneak in and get a good fill. And now, as soon as it bursts down, this all fires like microwave popcorn. Pop, 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 pop. And that's why, right after the collapsing dragon, it's not unusual to see a huge red candle all at once. So, by getting in at the buffer rather than chasing a falling knife, I get a much better entry. And then the move that this creates gives me an opportunity to move my stop from here to no lose plus dinner for two. So I'm already locking in the win while the other guys are trying to chase the breakdown. Check or hold. Okay. Yeah. So again, let's suppose that we had the price move to here, and this was the high of the day, and then this is the starting here. These are now new lows of the day, and then it got that low, and then it went up in here, and then it went down to here. Each time, remember, I started the range stat initially was there. That just tells me how big it could be today. But once it starts actually moving, this is still my range stat to the upside because that is the working low of the day. But when this rolls over and is going down, This is the high of the day. This used to be the high of the day at the open, but now this is the high of the day. When that's the high of the day, I have to drop my range stat to here. And because it went up that much distance, it now says what used to be possible is now going to be an irrational move because it already just moved a range stat from the current high of the day down to the limit of reasonable moves. So as this price varies during the day, you end up refining what the size of the next range stat move could be to what the limit is. And so it creates a diminishing envelope. It started off with plus and then minus, but it's always like it's up to here and down to there. And at some point, there's always a range stat move available in the direction that it's trading. And then this is the range of rational price because it's staying within that plus or average plus or minus one or average plus one standard deviation in each direction. But it can break out into the world of irrational and then it can just go. So the other the other data points that I want to know when I'm studying, when I am taking a look at a population of targets, my herd, and I want to specialize in those 60, like for me, it's 30 in the Dow and 30 ETFs. And when I say Dow, I mean individual companies plus a couple specials. I cut out some of the Dow members, but I got 30 stocks, 20 of which are in the Dow and 10 that are ads. I'm going to specialize in understanding how those 60 move. And what am I going to study? I'm going to go back 10 years and look at all the daily ranges. So that's 260 days a year times 10. I'm going to look at 2,600 uh, daily ranges for each of those. And I'm going to find the minimum. What is the smallest move? And I just say the smallest it could be is zero. It can't move less than zero. So it's going to move from zero. Then I'm going to find the absolute min, and maybe that's the minimum. I want to know the average, and I'm going to compute the standard deviation. So I'm going to go average minus one standard deviation minus one. So there's my average. Then I'm going to go, there's my average plus one. That's the long-term range stat, the 10-year range stat. The one that we do with just the 30-day, that can vary quite a bit. This one on 10 years does not change. What I really want to know is what was the max ever? What was the single largest move it ever made? And then I want to use my crystal ball and I'm going to say, what is the max that it ever will in the future? Because I don't know that. This is just the biggest move so far in its last 10 years. So I want to get some kind of sense of just how crazy this thing has ever moved and how normal has it ever moved. So if I know what the long-term average range percentage is, I can take a look at the long-term average and the current 30-day average, and I can say, hey, where does that stack up compared to the long-term average? Hey, that thing is only half of what the long-term average is going to be. And then you can actually see how this intermediate term volatility goes through cycles, just like the market does. Now, for practical short-term purposes, all you really need to know is the 30-day current average and range stat because we're talking about 1 to 5 days worth of trading, in that range. But if you're interested in longer term swing trading, you would actually love to know what the channel of that normal range percentage looks like, because guess what you can do then? You can put that average and put plus or minus one standard deviation on it, and you can say that is the long-term band of normal that it oscillates through. And can you guess where I really want to start trading swing trades on these big fat large caps? Right there. Because I'm going to have really tight risk boxes as it starts to increase in price and volatility. And then as volatility expands, my position just keeps getting better and better. If I'm buying it with a tight stop during periods of historically low volatility, the breakout on that one could be extraordinary over the next couple of years. That's usually geared to the business cycle and the market cycle as well. But that's what we use the range stat for, is to describe what the heck is going on. Now, second question. Oh, let me finally say, the gap, a big gap day was one of the times that we could expect to see increased volatility or more than a range stat. But it could also be uh, earnings. If it's in a critical state, compound critical state, or yesterday was a range stat move, because now I have direct evidence that we just had an unusually large event. And so for the next 2 days, I think there might be some carryover just because this thing was in a tight normal trading range. And then all of a sudden, range stat day. And now the next 2 days, I might see some follow through before it comes into a little doji and then picks up the normal size again. So any range stat day, the next 2 days, I'm thinking of continuation momentum, or like we saw today, we saw the Fed had a huge 1 day down day. And what was today? This and this. You had a range stat day yesterday and a range stat day today. So they come in clusters. They're not quite independent events, but this will start to chill out. And so there will be a short-term blip to the size of the range stat because of that, but then it'll normalize back to longer term averages. So that there, it's good to one of the ideas behind the sniper and the compound critical state is you're stacking up a bunch of reasons like location plus volatility plus a pattern that leads to a increased probability of large moves. That is exactly what the compound critical state and the sniper trading is trying to do. I'm trying to take a look at my 60 symbols and put the ones into the box that are more likely to have great big breakouts in either direction. So if I can pick the top 10 that are most likely to have big moves, and then I can start with the gap and then start looking for patterns, I have a greater than normal probability of a larger than normal move in either direction in short periods of time. So the range stat is the adaptive statistical measuring device that simply tells me how big is that big move that I'm expecting. and hasn't made that big move yet. And while it's moving now, how much more can I expect before irrational exuberance comes in? So we beat that horse to death.
And can I clarify something before you move to the next one?
Yes, sir.
When you drew the diagram, I think I've been making some mistakes in some of my entries. When you drew that diagram of the collapsing dragon, and you're
Yeah.
entering
Yeah.
not where the low of the price is, but you're entering where the
Oh, yeah. Yeah.
RL10 low
So,
is.
yeah. So you get this, you get some harsh winter. Okay. However far that fell, and the RL10, if you're color coding it, looks like this, it'll do something like that. Or maybe it comes to here and then goes up. This belly of the RL10 is the trigger for the collapsing dragon. That is the statistically significant price level. The the uh, the actual swing low based on price is, let's just call that the low of the, maybe it was the low of the day or whatever. It doesn't much matter. At the same time, you have the dragon is going to look like this because it takes a few more bars for the dragon to reverse. It's not as adaptive as the regression line. And so you can actually, when we first started doing this, we were putting collapsing dragon as a violation of the belly of the dragon. I've actually become more satisfied by using the point of the RL10, and mostly because it's really precise. So if you ended up getting, that SSC signal in here, but then price started to, when it hits the and violates the dragon, I'm already stalking my exit and I'm stalking the entry on the collapsing dragon. I look at that as alert one. And then this might, I might be entering in this space, but I'm certainly entering here. And then I have to be in before it breaks below here. And the reason is anybody that was part of this move was putting all of their stop orders down here
Oh, okay.
in a little bag below the low of the wick. But I don't know how many shares were traded inside that 1 minute or 3 minute bar. It could have been just one guy and he got filled down here and it draws it as a candle. There's just not enough information. And I'm not going to spend the time to go look at level 2 and come up with all the fucking, no, if you put the VWAP on the side and you look at volume at price, it'll show you, hey, there was this much volume traded at that price level, and then it'll typically look like this. So you'll get a lot of volume around in here, and then it diminishes down to nothing. So this isn't really where most of the guys made their decision to turn it around. All of the selling stopped probably right there. That's the statistically significant. That's where all the volume stopped. And this was very thinly traded. So this is where they turned. That's the statistically significant trigger price.
They're all
So
trapped now, all those
yeah, so
buyers.
when I get long here and I put my risk box to there, that means if it violates below the low of the RL10, I have a short-term bias. I'm short from here, and my stop is probably there, right?
Does that apply to Kata twos? I would presume in emerging dragons, we really are not
Yes,
supposed to wait for that price. We're
yes,
supposed to
yes. Because now
slow
the
down
SSC did
RL.
this, and then the RL10 reversed, and then the RL10 goes up again, right? So that's the RL10. Now, the Dragon is going to do the same thing on the upside that it did here. It turns slower and it's going to get up into here and it's going to look like this. And it's usually this, not quite drawn to scale. It will look, it looks like this. And so the price levels here look like that. So if I bought the SSC here, hooray, it peaks out, and now maybe my stop was, because it rolled over right here, maybe my exit was right at the skin of the dragon. So any exit that I get somewhere around in here is going to be okay. And now, what I would love to see is right after I exit, I would love to see that thing take off and go. Where I have to get in again is at the peak of the RL10 here. And this is going to be the emerging dragon. Any entry north of this level is going to be the emerging dragon. Any entry that is north of the skin of the dragon, but short, that's a pocket entry inside here. And this is a preferred place to enter because it's a little more tentative. We haven't confirmed a resumption of the new trend until it gets above the previous statistically significant price level over here. When it gets above that level, I now have evidence that there is new buying pressure. So I had a little bit of buying pressure, which turned it from here and got it all the way across the dragon. But that could have been all these other guys that were buying over here. This is tentative in here. I'm hoping that it's going to break out to a new high. If it breaks out to a new high, then I'm gold. So the logic behind this is that if I can get my entry in here or in here, now as this starts slowly creeping up, it breaks out above this. That's where the explosion occurs because everybody that was short here put all their stops above the previous high. So if this price can actually get through that and it starts hitting all of those stops, it's again like microwave popcorn. It starts popping and off it goes. So I want to get in here where the uncertainty is higher and the fills are better. And then if I can get my entry here, my my signal to go short from that collapsing dragon is either going to be here or there. Now my risk box is only like this. So I have less money, I have less price per share to lose, and I can be short. Whereas if I waited to enter up in here, my risk box looks like this. And now I have to have a much bigger reasonable target to get to 2R, whereas on this one, I can get to 2R right here. And I can get my risk out sooner. And I am potentially on a COTA 2, as we know that COTA 2 can actually just keep going and going. The sooner I can get into that thing, the longer term advantage I have for the return. That's absolutely crucial to understand.
Okay, thank you I appreciate that. I've been making a mistake on some of my trades where they'll have a wick just like you drew on the left side or some of the
Yeah.
shallower COTA twos, and I've been requiring the price to get above those wicks, but really
Yeah,
the
you
art.
don't want that. No, you want to use pin the pinpoint precision of the R10
Okay,
of his turning point. That actually defines the channel.
okay, great.
So now when you're just doing sort of visual box trading, if that's the size of my channel, and if I know the size of the manageable risk box, I can tell by inspection that that's 3 risk boxes. I can trade in that channel inside the channel. If that channel is so tight that my risk box is here, I cannot take that entry when it comes down here and bounces. I can't take that entry because the top of the channel is right there. I don't have 2 to 1. I have to actually wait for it to break out. That's actually the idea behind the Z3 pinch. the idea behind the Z3 pinch is that the 3 sigma Bollinger Bands have compressed to such a tight range, it's less than a frog box. I can afford to now wait for price to break through the Z3 and off it goes. When I'm way over in here and price comes down and reverses, and that's where my Z3 line is, I can get an entry here and expect to trade up to there inside the channel. But when the compression, this sideways choppy compression happens, this is where I start getting chewed up. So after 1 or 2 failures in here, I just have to put a lid on it and say stop trading until the Z3 lines have compressed so much that I have abnormal compression. All right, re-entry strategies, about 5 minutes. There's the universal entry and the 1, 2, 3 entry. So the universal entry looks like this. I got some entry, the thing worked, it came down, I hit there was some price action that got me out, and let's say that it was a big red candle that got me out, and so and maybe it was even bigger than that. Maybe the big red candle when it finally closed looked like this, and because of my rules, let's say that my exit was right here, and maybe this is where, yeah, it opened here and then it closed here, and now the next candle maybe it opens here and it starts moving up, and up it goes. And I look at this whole thing and I say, well, my previous RL10 low was there, and the RL10 low is here, and I had a successful trade, which got out in here. So I made a successful trade. Maybe that was a swing trade of 5D. So this could be intraday or whatever, but the time period does not matter. Whatever bar that I got out when I decided to exit, the next bar opens inside of that range and it breaks 5 cents above the high of that bar. This is my new mechanical entry, and we call that a universal entry. What I'm looking for is, you know, uh, big, strong moves, and then the bar of exit is here. Then wherever this new bar opens, and starts going up, that bar is open. I can enter on a breakout above this bar with that as my stop, as long as this bar that's now working has not made a new low while it's open, or and before I entered. I mean, it could very well trick me in, and now I'm long. And then while that bar is still open, it reverses in the same bar. And then if it goes below the previous bar's low, I'm out right away in the same bar. But sometimes you'll see, a lot of times you'll see prices moving up. You made an exit. You cashed a winning trade. Your original stop was down here. And as long as this, uh, what if this bar opens and then immediately starts going north? Opens here and goes north. Good. I'm in, and there's my risk box. And then wherever the R10 peaked, if it gets above here, off we go. So this is a poor man's visual box trading method. It's not even using the Dragon and the RL10. The universal entry is just get right back in. I don't need a 1, 2, 3. I'm not waiting for a 1, 2, 3 because I have extra information that this thing is in a strong positive move. But if I look at a 1, 2, 3, maybe price was monkeying around here, and then it goes 1, 2, 3, and makes that low. And then the next bar opens here and closes. When it closes, it had to be higher than the high. It had to have some price action above the previous bar, and his the low of this bar has to be higher than the low of that bar. You don't know if this is bar 1 and 2 until this bar closes. It's a tentative bar 2 until it closes. Then when it closes, if it had made a new high and a higher low, then and only then this is bar 2 and that becomes bar 1. Now, when this bar closes and you know it's bar 2, the next bar is bar 3 because it will open where that bar closed, and then your entry is 5 cents above that, as long as it didn't break the low of bar 1. And then that's where my entry is going to be. That's a 1, 2, 3 entry. Well, if you look at that structure, a 1, 2 looks just like a universal entry. But why can't I get on the second bar instead of the third bar? Because I had a winning trade and this made a higher low. Because I have that information, I don't need the third bar to confirm. I only need 2 bars. All I need is a higher low and a higher high. So what I'm looking for is, this is my bar of exit. What I'm looking for is, I can just automatically draw these 2 lines. And all it has to happen is it opens inside the real body, or it opens inside the range. Let's say it opens here and it breaks out. There's my entry. As long as it did not violate that low, I can enter here. And my stop is the previous bar's low minus a nickel. That's the universal entry. It had to have a strong, it had to have a winning trade and a higher low compared to where the original stop was of the winning trade. What that means is you can actually, you might have had a 5-day down, and then you got this nice move, and then maybe you got out at a 1, 2, 3 entry, or a 1, 2, 3 exit, and there's your bar, and then the next bar it just keeps doing this, 6 days, 7 days, 8 days down. It never gave you a universal entry, but the original winning trade had his stop right here. As long as this thing, when it turns, makes that swing low higher than the original stop of the winning trade, then you can take the universal reentry. That's a poor man's kata 2. When I'm just doing visual box trading, that's all I need, because my entry is right there and my stop is right there. That works really nice on 30-minute bars, up to 2-hour bars. I use it on 10-minute bars too. So that's the universal entry. And that's the 1, 2, 3 entry as well. If I didn't have that first winning trade, it just, I'm looking at is, hey, this thing was in a miserable, harsh winter, and the last bar looked like this, opened and closed, and then it opens and did something like that. That's now bar 1, that's bar 2, and it opens, sells off a little bit, and then goes higher. As soon as it breaks above that, there's my entry. Because I have evidence of higher lows, and I have it some evidence of higher highs. That is enough to get me in right there. And my stop is here. Okay. Now, other ways we can get in, if I just take a look at some of my the pattern recognition, like an RLXD or an emerging dragon. One of the reasons that we name and explain and demonstrate these different patterns is that they give us language in order to recognize patterns. And if I recognize a pattern and I'm familiar with it and comfortable with it, I may be able to. So there's my 1, 2, 3 exit, and there's my higher lows. There's my 1, 2, 3 entry. I can recognize that as a PSAR flip. There's my P1 RLCO. Here's my winning trade rolled over. Here's my pocket. There's my emerging dragon. So if you have recognized patterns, you can use those as reasons to re-enter. The one I just like the best for Kata 2 is the RLXD and the PSAR flip. Actually, the PSAR entry. So remember, the PSAR as we draw it, as we calculate it, is based on the RL10 value. And when the RL10 reverses, let's see, when the RL10 reverses and the RL10 goes through the PSAR, and then that price bar closes, when that price bar closes, the next bar is going to be the PSAR flip. Well, uh, I like to enter when price goes through the PSAR dot -1. So that could be an entry. But then if I get this, I like the regression line crossing the dragon, and that will happen usually before the PSAR flips. So this thing could have been moving up like this, and then the PSAR is coming down like this. So now price is coming down, and then price starts going up. When the RL10 reverses, enters and crosses the dragon, wherever price is when that happens, I'll buy it. It's usually up around it in here. If price went through the PSAR, I'll buy it on a reentry. But if it hasn't gone through there yet, and the RL10 comes through the dragon, then I'll buy it. What could that look like? The RL10 looks like this, comes down, it reverses. The dragon is slowly just moving along here. And the PSAR. So when the price action, I'm going to draw it in pink. So when the price action was here, it can actually reverse and go up through the PSAR before the RL10 can quickly reverse and even get across. It's not even across the dragon yet, but the price went through the PSAR. I'll enter there. But sometimes that price, instead of just being a rocket ship straight up, sometimes it'll monkey around and it'll be mucking around in this area. It hasn't crossed the PSAR yet, which is still decaying, and the RL10 gets across the dragon. The fact that the RL10 was strong enough to get across the dragon is reason to buy it. But if the price goes smashing through there, I will also buy it. One of those two things causes me to buy. Price goes through the PSAR -1, the previous PSAR dot, or the RL10 has crossed the dragon. This one is interesting, the new high or low of the day. So you might have had price went up and it made a new high and then it reversed. And then right away it just breaks out again. If that was actually the high of the day, I just immediately get right back in. I don't even worry about that crap. I just say it normally is like a 1 bar tick and then reverses again. I'll get out, get in right away. New high and low, but especially low of the day, the hint of failure is enough to get me in right away. What things cause you to choose different strategies to re-enter? You will develop skills about where is the trade location during the day. Is it like if this thing had 5 pot of 2s, I might be very quick to hit a pot of 2 right away. But if it was a weak SSC and then the pot of 2 immediately failed and then gave me another pot of 2, maybe I don't get in. So trade location, the size of the legs, the time of the day. Am I in the strongest stock in the strongest sector? Did I have a successful trade beforehand that I can use markets money to follow my intuition? Where am I in that whole money management strategy? All of those things go into deciding how and when to do I enter in the pocket or do I wait for the confirmation of the emerging dragon? That kind of stuff. So those are some of the things I would say about reentry. Okay. That's everything I want to cover, and we'll get this published and posted.